20 oil tankers sat motionless in the Persian Gulf for over 100 days, holding 35 million barrels with nowhere to go. The Strait of Hormuz wasn't just closed, it was mined. Iran laid underwater explosives across the 21-mile chokepoint after U.S.-Israel strikes killed Iran's supreme leader in February, cutting off the route that normally carries one-fifth of the world's oil. The mines are what made this different from every other Hormuz crisis. Ships couldn't risk the crossing. Oil flows collapsed from 20 million barrels a day to 2.2 million by March. Iraq's oil revenue fell 76% in a single month. Fuel prices spiked globally while tankers accumulated in the Gulf, waiting. On June 17, the US and Iran signed a deal with one critical clause: Iran would demine the strait within 30 days. Since then, oil flows have climbed to 5.1 million barrels per day, the highest in 4 months. The stranded tankers are finally moving, bound for Asia by early August. But the strait is still only carrying 25% of its normal traffic. The main central route remains mined. Iran is clearing alternate channels first, and every ship that passes is threading through a corridor that's still being swept. The 30-day clock is ticking, and the world's fuel supply depends on it finishing on time. Brent crude oil fell below $75 per barrel while the Nasdaq stock index declined for the third consecutive day. A market analyst described the situation as carnage continues in oil prices as crude prices extended their downward trend. The simultaneous decline in both energy markets and tech-heavy stock indices signals broader investor concerns. Falling oil prices squeeze energy sector revenues and can signal weakening global demand expectations, while consecutive Nasdaq losses indicate sustained pressure on technology valuations. This dual decline reflects mounting market anxiety over economic growth prospects and suggests investors are repositioning across multiple asset classes in response to macro headwinds.